On January 3rd, Burton Malkiel, author and professor emeritus of economics at Princeton University, released a 50th anniversary edition of his book, The Investing Classic, A Random Walk Down Wall Street. Want to learn more about exactly what's covered in this fully updated anniversary edition? Here's an excerpt from the book's description. In a time of rampant misinformation about ways of growing your money, Burton G. Malkiel's gimmick-free investment guide is more necessary than ever. Whether you're considering your first 401k contribution or contemplating retirement, the fully updated 50th anniversary edition of A Random Walk Down Wall Street remains the best investment guide money can buy. Drawing on his experience as an economist, financial advisor, and successful investor, Malkiel shows why an individual who saves consistently over time and buys a diversified set of index funds can achieve above average investment results. He addresses current investment fads and critically analyzes cryptocurrencies, NFTs, and meme stocks. Malkiel reveals how to be a tax-smart investor and how to make sense of recently popular investment management techniques, including factor investing, risk parity, and ESG portfolios. Investors of every age, experience level, and risk tolerance will find the step-by-step guidance they need to protect and grow their dollars. Barron's has already declared this 13th edition a must-read, and Burton recently sat down to talk about the book with CPA attorney James Lange. Jim is the president of 3 interrelated companies, a retirement and estate planning law firm, a CPA firm, and a registered investment advisory firm. A prolific writer, Jim's retirement and estate planning strategies have been featured in the Wall Street Journal 36 times, and he has authored 8 best-selling books. Jim is also no stranger to interviewing financial luminaries. For many years, Jim hosted a weekly radio show and spoke with an array of experts, including Ed Slott, Roger Ibbotson, and even Jack Bogle himself. We hope you enjoy this insightful interview that Jim did with one of the most acclaimed economists and investment experts of our time, Burton Malkiel.
Good afternoon. I'm Jim Lange, and I'm here with Burton Malkiel. And I wanted to start by congratulating Burt on his 50th anniversary edition of A Random Walk Down Wall Street. There's already 2 million books of former editions in print, and who knows how many books he's going to be selling this time. This book is in practically every list of the most important financial books in history. Personally, I think the introduction alone is worth many thousands of dollars to any investor who would read it and put it into practice. And Burt, let me start with a question, because in the introduction to the book, you quoted something that you wrote 50 years ago. And what you said was, a blindfolded chimpanzee throwing darts at a list of stock prices could select a portfolio that would do as well as the portfolio selected by experts. Now, at the time, you were demonized. There was all types of negative press, and even you yourself joked that you and Jack Bogle were the only shareholders of what was then known as Bogle's Folly, which of course now is known as the Vanguard S&P 500. Do you still think a blindfolded chimp would do as well as the experts?
Actually, Jim, I believe in that even more strongly than I did 50 years ago when I first wrote the book and before index funds were even invented. I absolutely believe it now. And there are 50 years of evidence to prove that it's absolutely true.
One of the things that you do throughout your entire book is that you document and provide evidence for virtually every assertion that you make. What kind of evidence can you maybe quote or refer to that actually proves that the blind chimp could do as well or better than the portfolio experts?
Well, there are several empirical academic studies, but there are also studies that are available for all investors to look at by just going into the internet. The Standard & Poor's Corporation does a study every year, and it's called their SPIVA study. SPIVA, the idea is it's SPIVA, and it is the Standard & Poor indexes versus active managers, versus those people on Wall Street who are picking securities and putting together, quote, professionally managed portfolios. So SPIVA does these every year. And in every new edition of the book, I quote the SPIVA results, and they are amazingly consistent. That is to say that in every single year, you find that 2/3 of the stock pickers do worse than a broad-based index of all stocks, which is exactly what's in an index fund. So every year, 2/3 of the brilliant stock pickers are outperformed by the index. And the problem is that the 1/3 who do better in one year are not the same ones as the 1/3 who do better in the next year. So that when you compound the results over 10 or 15 years, you find that now 90% of the active managers are outperformed by the index. Now, I'm not saying that it's impossible. I'm not saying it's impossible. You will find there are a few managers who have done it. There are people like Warren Buffett. But to try to find those for an ordinary investor, you're much more likely to be in the 90% part of the distribution where you do worse than the index. And interestingly enough, even Warren Buffett, who must be, I think most people would say, is our most successful investor, even Warren Buffett has not outperformed the index over the last decade. And he has recommended in his will that his assets all be invested in a simple, broad-based index fund. So the evidence is very clear. And in fact, if listeners want to prove it for themselves, go into the internet, look up the Standard & Poor's so-called SPIVA, S-P-I-V-A studies, and you will find exactly what I am telling you.
Well, so let's assume that the broad-based index does outperform. Are you taking into consideration maybe fees that a portfolio manager would have or any additional trading costs?
Absolutely. And I think that is one of the reasons why the index fund has such a wonderful record. There is a table in the 50th anniversary edition to actually demonstrate how different the results are because of fees, because of expenses, because of trading costs. And you find that the active manager not only underperforms, but underperforms by approximately 1 percentage point a year. And that's terribly important because these fees compound just as returns compound. And Albert Einstein once said that compound interest is maybe the greatest force in the universe. And compound interest is what makes a 10% return for something invested in 2 years, not if you don't invest $1 for 2 years at 10%, you don't have $1.20, you have $1.21, because the 10 interest from the first year makes money. Your interest makes money as well as your principal. So you have $1.10 after 1 year and $1.21 after 2 years. That's the miracle of compound interest. Well, the costs compound too. And the difference in terms of dollars is simply remarkable. There's another chart in my book. This isn't readily available for everyone. It was done for me by the Vanguard group. And it took the following calculation. It said, what if you're a person of very modest means? You don't have much money at all. Your thought of becoming a millionaire is just as far away from you as you could possibly imagine. So I'm saying, what if you invested $20 a week? You know, there's a couple of trips to Starbucks for your breakfast and your latte. What if you invested that in an index fund starting in 1978, which is when the first index fund was actually in existence? The index fund was not in existence when I first wrote the book. So what if you did that? $100 a month put into an index fund and consistently left in the market, left to grow at the returns of the stock market. What do you think you've got today? You've got almost $1.5 million. So that anybody, any ordinary person can do this, and you can become a millionaire. And if you're lucky enough to work for a company who will match your $100 a month, you could have $3 million from doing this. So it is possible, and you can do it with index funds. And there is simply no question in my mind. It's very unusual when, in fact, the best investment advice you can get is also the simplest. You know, people in Wall Street will tell you it's too complicated. You can't do it. You need professional help. You don't need professional help. It's very, very simple. You just need to put aside a certain amount each month, each pay period, put it into an index fund, make sure it's in something like an IRA or, you know, and I'm sure, Jim, your recommendation for people, young people now starting out, put it in a Roth IRA. And then not only does it compound tax-free, but you can take it out tax-free. This is just the best advice anybody could get, and you can do it with a simple index fund.
And by the way, that's an indirect, though I know you didn't mean it that way, plug for your book, because you show people how to do it. You are very thorough in your reasoning, but then also the practical applications. So what I guess I'm saying is you don't have to be a multimillionaire to buy your book and get enormous value. And I was not exaggerating when I said the introduction alone was worth thousands and thousands of dollars. So your premise, even before there was a broad-based index, was something like what you envisioned. A broad-based index was better than picking stocks. And you've given us a lot of backup here. So what is the major difference between your first edition 50 years ago and what you have written today, which I believe is going to be released January 3rd, 2023?
Well, in fact, the basic message has not changed. What has changed is what is available today for investors. As I mentioned, index funds didn't exist. Exchange traded funds did not exist. International funds did not exist. Money market funds where you could keep a cash reserve didn't exist. Roth IRAs didn't exist. 529 savings plans didn't exist. So the main differences are that the instruments that are available to actually do the strategy are entirely different, and they have in fact changed from period to period. There are also many new research findings that have been put in the book. Let me give you an example. There, as the book has changed, a new chapter on what is called behavioral finance has been included, because sometimes in investing, we are our own worst enemies. What we tend to do is we get over optimistic when the market is going up, and we then put more money into the market, and investors do this regularly. The data are there, they're very clear. And then when times are tough, you know what people do? They take money out. This is exactly the time when they ought to be putting money in. As Warren Buffett has said, you buy when everyone is fearful. That's what you should be doing, but your emotions get a hold of you. And we are our own worst enemies. So avoiding mistakes, there's a whole chapter with all of the new information about behavioral finance. These are the kinds of things that have changed. And in fact, the actual instruments and the specific advice is entirely different from what it was 50 years ago, because the opportunities for investors, not only in investing, but in tax saving, are completely different from what they were 50 years ago.
And you did a fine job, in effect, updating some of the choices and some of the tax strategies. And by the way, I love that the chapter on behavioral finance, and particularly when you said everybody overestimates their own personal abilities, you know, and I think you cited a study where practically everybody thought that they were a much better driver than everybody else. So I thought that was very appropriate. Today, though, don't we have complications that we didn't have before? So, for example, we have huge real estate bubbles, then we have crashes, then we have tech stocks, and we have all these things going on that could have a significant impact on our investments. Do you still think that a simple strategy where somebody that doesn't have a great background in all these things could still outperform, you know, the Harvard MBAs that have studied this for 30 years?
Sure, I do think so. But let me talk for a minute about the point that you make, which I absolutely agree with, that there are bubbles. The market does go crazy at some time. And one of those times was at the end of the 1990s and the beginning of the year 2000, in which we had what was, I think clearly in retrospect, a major bubble in stock prices. And a lot of people say, well, doesn't this show that you can't just buy an index fund, you can't just trust the market? Well, it's true. the market does go crazy at sometimes. The market more recently went crazy with so-called meme stocks, where GameStop, the video game company that was trying to sell video games with from stores when everyone was buying them online, would double and then double again. And, it was absolutely crazy and was another bubble. Here's the problem, though. The experts can't tell you when the bubble is going to end. And let me give you a couple of examples. The dot-com bubble, which was the bubble around the turn of the millennium. The term irrational exuberance was coined by Alan Greenspan, who at that time was head of the Federal Reserve. And Alan Greenspan had it nailed. He suggested that the market was irrationally exuberant. But you know when he said that? He said that in 1996. If you had bought in 1996, you would have been invested during one of the greatest bull markets in history. It was March of 2000 that the market bubble popped. So even the smartest and rationalists of people did not know that when the bubble was going to pop and what the extent of the bubble was. Let's talk about the so-called meme stocks, the AMC theaters and the GameStop, the ones recently that doubled and then doubled again and then crashed. Well, a very smart hedge fund tried to sell those things short. It was called Melvin Investors, and they went bankrupt because they sold short too early. So you're right, the market does go crazy at some time, but still nobody, and I mean nobody, can tell you, sure, from time to time, someone's going to be lucky and make some money, but nobody can consistently tell you when those times are and when the bubble will pop. And let me just mention one other thing, Jim, and this is a lesson that's in the book that shows you how even when markets are tough, consistent investing works. And it's the idea of so-called dollar cost averaging. And what dollar cost averaging means is simply doing what I suggest, putting a certain amount in every week, every month, every year. And what you do then in a market that is fluctuating is that you are buying more shares of the index fund when the market is down than when the market is at its top. And so even in a period where the market starts at, say, 100, it goes to 150, it goes into bubble mode, it then goes down to 75, and it ends up at 100. Say, take a market like that. Because you're buying more shares when the price is low, you can even make money during a period when the market has been absolutely terrible. And I'll give you an actual example. Suppose now you started investing in 2000, January of 2000, which was just about the top of the bubble that we're talking about. For the next 10 years, the market did not go up. The market crashed, the market then went up, the market then crashed again in 2007. This was often called the lost decade. So you might say, well, obviously, if you were really smart, you wouldn't have been invested during the lost decade. But the investor who dollar cost averaged, who consistently, sure, they bought stocks at the top, but they were buying more shares when the stock was down at the bottom. And that investor during the lost decade, by simply dollar cost averaging into an index fund, made almost 6% a year on their money. So do I still believe in it despite the fact that there are bubbles? Absolutely. And be consistent with just putting your money in period after period. And I am convinced you will continue to do well, even in a period or periods when the market seems like it is absolutely horrible.
And to complete it, you also are a big fan of, if you have a job, to take advantage of the employer match, and particularly for young people to do Roth IRA and Roth 401k and Roth 403b contributions.
You bet. Absolutely.
So
And
you
this
get
is
the tax
where
efficiency
your
also.
advice to people is just right on.
So is this even true when you consider a lot of people say, hey, with the market manipulators and, you know, the people selling short and people who are, let's say, inappropriately controlling the market, and how can the poor investor who doesn't spend all day studying this, how can the poor investor overcome some of the market manipulations and criminal activity or semi-criminal activity that we see going on?
There's no question that these things are going on, and what it has done, it has made the market even more volatile. There are hedge funds that are doing an enormous amount of short selling. There are people who are actually investing with a so-called momentum strategy, and it is making the market more volatile. But you know what? The individual investor who dollar cost averages will do even better, because the more volatile the market is, the more advantageous dollar cost averaging is, because during those periods when the market does fall out of bed, those who have the consistency to be investing then are going to be buying more shares and doing even better. So yes, there is that kind of thing. It's created a lot of volatility, but the dollar cost averaging investor will benefit from it rather than suffer from it.
That sounds great. You know, so even though I'm changing a little bit on the fly, I basically wrote a bunch of the questions that I'm asking, but I also sent out an email to my list saying, do you, that is you, people who are members of my list, have any questions for Bert? And we got a bunch of responses. Would it be okay if we took a question or two? Maybe Erica can read them for you. And that way, instead of hearing, let's say, just for me and my questions, that we can hear from some others. Would that
Sure,
be okay?
I'd be delighted, Jim. Delighted.
All right,
to do.
Erica, do you want to take over from here?
Absolutely. Thanks, Jim. So since you're talking about, or at least recently, since the two of you have been discussing the efficient market hypothesis, I thought that I would start with this question from Doug in Carlisle, PA. It's kind of a long one, Burton. I apologize, but I think
No
it's
problem.
an interesting question. He says, passive investing with index-based portfolios has grown in popularity for good reason: higher average returns, low taxes and fees, etc. But at some point, if the percentage of passive index-based investments surpass actively managed portfolios, is the efficient market hypothesis still valid? If we assume, for instance, that 99% of portfolios were all passively index-based, at that point, can all the information available regarding a stock be reflected in the price. It seems to me that this shift will break the capital markets. Thank you very much for your inspiring lifetime of research and education.
Okay, good, very, very good question. And let me first say that it is already the case that with respect to mutual funds, that more than half of the money in mutual funds is now invested in index funds. And, you know, in a way, your question points out the paradox of the efficient market hypothesis, which basically means that information gets reflected quickly. And you do need active investors in order to have that information reflected. In other words, if a drug company finds a cure for a particular kind of cancer that did not have a cure before, and the drug company was selling at 20, and this cure was going to make the drug company worth 40, the active investors will make sure that it goes to 40, not slowly over time, but really very, very quickly, so that everyone who buys will be buying at what's the appropriate price. So let me take your question. 99%, let's say 99.9% of investors index. Could it be that that breaks the market? And my view is no, not in a capitalist system, because let's say 100% of investors were indexed. This drug company gets the cure for cancer, and there are no active investors around. And there's some guy sitting in New York with a pile of money, and he says to himself, hey, wait a minute, you know, I just read about this new cure for cancer that this drug company had. The market didn't move. Can you imagine in a capitalist system that that person is not going to take the money he or she has and invest in that stock? I think it's inconceivable. Even if 99.9% of investors were indexed, there are always going to be some people, some hedge fund in New York, some private equity manager who is going to say, hey, wait a minute, there's an opportunity. And I don't care, even if it looked like everybody was indexed, there's somebody in a capitalist system that we have who's going to come in and take those profit opportunities. They're not gonna keep lying around in the ground. You know, there's a joke that we academics tell that I think is relevant here. And that is the professor and his graduate students are walking along the ground, and the graduate student sees a $100 bill lying on the ground and begins to stoop to pick it up. And the professor says, no, markets are efficient. Don't stoop to pick it up. If it were really a $100 bill, it wouldn't be there. Well, my rule for the graduate student is pick it up right away, because it isn't going to be there for long. And those $100 bills are not going to be there for long. Somebody, even if we were all professors, even a professor is going to stoop down and pick it up.
We're giving you an exclusive opportunity to receive a free book. That's right. If you purchase a digital or hardcover copy of A Random Walk Down Wall Street 50th Anniversary Edition by Burton Malkiel, we'll send you a free digital copy of James Lange's forthcoming book, Retire Secure for Professors. It's a wonderful book for professors, university staff, or anyone who has significant funds in their IRAs and retirement plans. And it features a foreword written by none other than Burton Malkiel himself. Just purchase your copy of A Random Walk from Amazon.com, Barnes & Noble, IndieBound, or one of the other many booksellers where it's available for purchase. And then visit paytaxeslater.com/random walk and complete the form to receive your free digital copy of Retire Secure for Professors. And as an additional bonus, the first 100 people to purchase either the ebook or the hardcover edition of A Random Walk and complete our form will also receive a free hardcover edition of Retire Secure for Professors as soon as it's available in print.
And I'll take the liberty of mentioning that your book is full of examples of people who think they have an edge and then they get punished terribly because they violate some of your principles. Erica, why don't we do one more and then maybe we'll go back to some of mine.
Absolutely. So this next question is from Steve in Center Valley, PA, and he asks, how might decisions made by the Federal Reserve impact the future of the stock market?
I don't think there's any question about the fact that the actions of the Federal Reserve certainly affect the level of the stock market. And in fact, that really brings up another point of why some of the additions have given somewhat different advice. The Federal Reserve, I believe mistakenly, had kept interest rates basically at or near zero for a long period of time. This made bonds really terrible investments. And it really made stocks far more attractive, certainly relative to bonds and relative to the fact that you really couldn't earn any money at all putting your cash into a safe investment. So there was really no alternative. It did affect the stock market. It made the stock market higher. And one of the reasons that the stock market was not good in 2022 was that, as everyone knows, the Federal Reserve being behind the curve and recognizing they were behind the curve, increased interest rates sharply. This made bonds better investments, but it also, on a relative basis, made stocks worse investments and made stocks relatively much less attractive. So does the Federal Reserve affect the stock market? Absolutely. And when the Federal Reserve pivots, is that going to affect the stock market? Absolutely. However, you don't know, and in fact, the Federal Reserve doesn't know when it's going to pivot. So while there's no question, this is a factor affecting stock prices and will affect them in the future. Neither you nor I nor Jay Powell knows when that's going to happen. So don't try to think you're smart and act on it.
This is the first time that you've brought in, bonds or fixed income into the conversation. And in your book, you said that most investors are risk adverse. And then you even took the liberty of saying, like your wife, Nancy. If most of your readers and most investors are risk averse, and let's say, at least for the, I don't know if we can generalize and say some of the older readers and listeners are not necessarily great spenders, do you have to take unnecessary risks in the stock market, or can you have a fixed income portfolio that will get you what you need to live comfortably the rest of your life?
I would say this, you're absolutely right that older people, particularly those living off their accumulated savings, do need a fixed income. Let me just say this dollar cost averaging that I suggested for people who are accumulating wealth is not what one does when one is retired and who has to take required minimum distributions from their savings. Say they don't have the Roth that you would like to have them have, but they are facing RMDs, required minimum distributions. You don't want a dollar cost average out of the stock market, because then you're selling more when the stock market is down. You need a portion of it that's in fixed income. And I would say that, in fact, what I would recommend for investors today is that if, let's say, you have an RMD of $50,000 that you need to take in 2023, I would make sure that that money is invested in a 4% one-year treasury bill, because you don't want to take risk with it. So in fact, the same investment strategy is not the optimal strategy for people in different stages of life and with different asset accumulations. And for many older people, you do need some fixed income. Now, it was a particular problem a couple of years ago when the yield on a one-year treasury bill was close to zero. And at that point, I had suggested some bond-like substitutes, like very high quality bank preferred stocks where you could get a 5% yield. And there was a whole section that suggested what you might do in periods when the Federal Reserve had forced interest rates down to zero. So, yep, you want to look at see what kinds of returns are available. But your general question that some people are not, if you're 20 years old, you can have a full equity portfolio. You've got your earnings of your lifetime ahead of you. You've got a whole lifetime to accumulate returns from the stock market. But if you're 80 years old and you're living off that money, you need a different portfolio. Absolutely.
Does inflation have an impact on, let's say, your asset allocation or what you should be investing in?
It certainly does. And this, for me, suggests that when you look at the returns over the last 100 years of different asset classes, where we've had long periods of inflation, you find that common stocks are, in fact, the most reliable inflation hedge that we have. And what inflation means to me is that even if you are risk averse, you should, and you're young and risk averse, and you don't like those fluctuations. They make you, they give you trouble sleeping at night. There's an old story about J.P. Morgan. Had a friend who said, you know, I'm all invested in equities. They're bouncing up and down. I can't sleep at night. And J.P. Morgan said, well, you should sell down to the sleeping point. Even people who are very risk averse and young, though, look, you still need equities during a period of inflation, because over the long pull, equities have been a completely reliable inflation hedge, not in the short run, but over the long run, equities are your protection against inflation.
And what if you combine either a down market or even a full-blown recession and inflation at the same time? Are you still going to stick by your principles and invest in equities at that point?
Okay, very good point, Jim. It's a terrible time for the stock market when you have both inflation and stagnation, or what is generally called stagflation. So let's look back to the period where we experienced that, and that was the 1970s. The 1970s were a period where the stock market ended the decade about where it started. Lots of big fluctuations, a period when the stock market went down 20% in one day. Just a terrible time for investors. So would I say no, that was the time to be out of the stock market? No, even in that period where the stock market ended up where it began, where it was frighteningly, staggeringly volatile, the dollar cost averaging investor made almost 5.5% per year. So even then, I would say stay with the stock market. First of all, you can never predict in advance when these things are going to happen. And even if they do, the dollar cost averaging investor will come out okay. And look, there are issues. Let me be very honest to people. This might be a tough environment coming up, even in 2023. We've got the situation where inflation has been very sticky. I'm not sure the Federal Reserve is right that it's going to come down to 2% by the end of 2023. I think it's going to be very sticky. I don't think we're going to have rapid growth. For one thing, the demography in the United States is just terrible. The population is not growing, and the population is aging. The working age population isn't growing at all. So we're not going to have rapid growth. At least it's very likely that we will not have the kind of rapid growth that we've had in the past. Could we have stagflation for the next 10 years? It's absolutely a possibility. I'm not sure. Nobody is sure. But even if that's the case, stay the course. You won't do anything better as a young person investing for retirement than to keep putting your money into a simple, broad-based index fund.
And one of the things that you do in the most recent edition of A Random Walk Down Wall Street is that you actually have some different recommendations for different people at different stages in their life. So it's not just a theoretical book, put money in stocks. You actually give people a lot of guidance in that area. So I guess one of the objections to the index is that you're kind of guaranteeing mediocrity in your investments, and that some will do better, some will do worse, but you're kind of guaranteeing mediocrity. Is there an answer for people with that objection that no, the evidence is just overwhelming and you are not guaranteeing mediocrity, you're actually guaranteeing a better return?
The evidence is very clear that you are guaranteeing a better return. As I suggested earlier, the evidence is that the average active manager underperforms the index by 1 percentage point per year. And that's not even considering that the average active investor, if you're holding your stocks outside of a tax-advantaged retirement plan, that the active manager will present you with a 1099 at the end of the year. And you can bet your bottom dollar that that 1099 is going to give you a lot of taxable income and taxable capital gains, because they are churning the portfolio. The capital gains are often short-term, which are taxed at regular income tax rates.
Well, you keep sticking by some of your classic advice, and I keep trying to, let's say, edge, well, gee, isn't this different? Isn't that different? Let me throw out another thing that might be different, although I think that you're going to say, no, it's similar. And what I'm hoping to do is, let's say, maybe look at areas where you might be underestimating some of today's trends. Let me be specific on one, and that's ESG investing. And by ESG, I mean investments that take into consideration the environment, the social fabric, and governance into account. And you do discuss ESG investing, and you point out the problems about the definition of ESG, and is this really ESG? And you point out some of the let's say issues with it. Then you also say that there has been no significant investment advantage. You do say that either ignore ESG, or perhaps, and your exact words were, add an allocation to a renewable energy company or other company that is consistent with your specific ethical goals. But you also cite some people who are maybe at a slightly different point of view. And one of the people that you cite, and you do this throughout the book, is Larry Swedroe, who I've had the honor of talking with many times. And he says, when he's talking about ESG, that this is good business. It's good business not to pollute. He also says that if you are a company and you are environmentally sensitive and you're taking into consideration some of the social fabric, et cetera, that you will become a more attractive company to work for. And in today's very competitive labor market, especially for young, talented workers, that you're going to be able to attract more workers and better workers, and hence the value of the company is going to go up because they're going to have a labor advantage. How would you answer Larry, who would say, gee, maybe you should be looking at ESG not just to feel good, but because it will actually be a better investment over time?
Let me, first of all, suggest to you that if you look over the last 5 years, when so-called ESG funds have been available, and compare them to index funds, you will find that they have actually underperformed, just as typical active managers have underperformed. They have higher fees, and they have simply not done as well. So while I fully understand that people would like to feel that their investments are doing good for the world, and they will also do well, they are not doing well financially with this. And also, I'm not sure that if you look within those ESG funds, whether you really will feel comfortable that you are doing good for humanity. Let me give you a couple of examples. there is a utility in the Midwest called Xcel Energy. Xcel Energy burns a lot of coal in producing power. And the ESG funds say, no, we don't want, we're not going to feel good investing in Xcel Energy. But Xcel Energy has invested more in wind power and solar power than any other utility. And Xcel Energy is the only utility that has promised to be carbon-free by a date certain. So do we hate Xcel Energy because they burn coal? Or do we applaud them because of the good things that they do? Facebook, or Meta, as it's called now, is one of the top holdings in the ESG funds. Visa, the credit card company, is one of the top holdings in the ESG funds. Do I feel good about investing in Facebook and what some of the things they have done to society? Am I really happy about it? Am I really happy investing in Visa that is charging exorbitant interest rates to poor people in the country? So when you go and press this, it just isn't clear that when you're buying an ESG fund, you're either helping humanity or whether you are helping yourself. And we've had a lot of what's called greenwashing, that a lot of funds have renamed themselves as ESG funds when they weren't ESG at all. Now, look, I don't want to sound too negative. I fully understand that people would like the idea of investing in good companies. And in fact, companies that are good for their workers are, Larry Swedroe is absolutely right. They're going to be better companies and they're going to be more profitable companies. So look, I don't want to invest in bad companies, but it's just much more nuanced and much more complicated than it actually seems. Now, let me tell you one other thing that Larry Swedroe has said, and he's got a book on ESG investing. And one of the best findings in that book is, and Larry's a wonderful investment manager and a very, very smart person. He says, look, suppose we're talking about wind power. Is that going to make more money for investors? And what Larry says is, as people start buying up wind power stocks, they might outperform for a time. But after ESG has become popular, and a lot of people just say, I want to be invested in wind power because it makes me feel better, then the wind power stocks are going to yield and return less over time. And that's one of the important findings about Larry's book on ESG investing. So look, here's what I say. ESG funds, even broadly diversified ones, are not a substitute for the broad-based index funds that I recommend, because I think they are neither completely pure, nor are they going to outperform. They're going to underperform. And secondly, if you want to do this, if you want to invest in, you want to have a solar power stock in your portfolio, you want to have a wind power stock in your portfolio, You want to have a water treatment facility in your portfolio, fine. But do it as an add-on to a diversified index fund. I don't think you'll make more money with it, but if you want to do that, fine, but you'll do it with much less risk and much less hurt to your financial results if you do it as an add-on rather than that this is going to be your whole portfolio.
Well, that was a great answer. And I'm a little bit disappointed that I can't argue with it, and unless you're actively willing to take a lower return, because not everybody would be willing to do that. Erica, do you want to do one or two more questions, and then we'll see where we are in terms of wrapping up? Well, why don't we take one or two more questions, and these came from some of my email subscribers.
Sure.
Is that all right, Burton? I know we're going a little over schedule for today's session, but is that okay with your schedule?
Absolutely.
Wonderful. Okay. So the next question I have comes from Ronald in Portland, Oregon. He said, I own the 2007 edition of your book, The Random Walk Guide to Investing. What changes would you make today to the life cycle investment guide on allocations charts in that book, particularly for the age bracket late 60s and beyond?
The change that I've made is the following, that in view of some of the questions that Jim gave me about inflation, the recommendations that I have made for all age groups include a few more equities, a little larger proportion of equities than I did in 2007. So I would say the first change is it's a bit more equity recommendation and a bit less fixed income, in part because I do think we're likely to have a lot of inflationary pressures in the future, largely because the demography, not only in the United States, but in Europe and especially in Japan, it just doesn't look good for the future. Japan's going to lose a third of its population by 2050. So there's going to be a lot of labor shortage, a lot of pressure on prices. The second change had to do with what do you do with fixed income? In particular, what do you do when the Federal Reserve has pushed interest rates down to zero? And this may happen again because we have huge government debt. We have in the United States, we have it in Europe, we have it in Japan. And there's something called financial repression, that the way the government gets rid of debt is the way they've gotten rid of debt throughout history, namely by inflating it away. They're not going to get rid of a debt by increasing taxes and stopping spending. Don't count on that. They're likely to get rid of the debt by inflating it away. And to the extent that they do that, and to the extent that the Federal Reserve goes back down to very, very low interest rates, I have suggested things like bond substitutes for actual bonds to at least give people who want some kind of and need some kind of fixed income in their portfolios to be able to do it and to be able to get some positive rates of return.
Well, I'm not sure I can think of a better way to end at least this part of our discussion. I want to thank you for providing such wonderful information in your book and this interview. Again, I cannot overly stress the importance that while this has been a great interview and we're going to have one or two more, that I would highly recommend that you buy the book. And Bert even mentioned that you don't have to be a millionaire now to take advantage of the concepts and advice in it. Bert, thank you very much. This will wrap up this interview. I know you have been generous enough to offer your time for one or two more, and we will have those, and I'm not sure when they're going to air, but relatively soon. So thank you very much.
Thank you, Jim. I really enjoyed it.
We hope you enjoyed this video, and as a thank you for watching, we're giving you an exclusive opportunity to receive a free book. That's right. If you purchase a digital or hardcover copy of A Random Walk Down Wall Street 50th Anniversary Edition by Burton Malkiel, we'll send you a free digital copy of James Lange's forthcoming book, Retire Secure for Professors. It's a wonderful book for professors, university staff, or anyone who has significant funds in their IRAs and retirement plans. And it features a foreword written by none other than Burton Malkiel himself. Just purchase your copy of A Random Walk from Amazon.com, Barnes & Noble, IndieBound, or one of the other many booksellers where it's available for purchase. And then visit paytaxeslater.com/random walk and complete the form to receive your free digital copy of Retire Secure for Professors. And as an additional bonus, the first 100 people to purchase either the ebook or the hardcover edition of A Random Walk and complete our form will also receive a free hardcover edition of Retire Secure for Professors as soon as it's available in print.